Would you like to learn a timeless portfolio from an investing legend who is worth over $15 billion? His name is Ray Dalio, and the portfolio I'm talking about is the Ray Dalio portfolio, also known as the All Seasons portfolio. Ray Dalio is one of the most successful investors of all time. His company, Bridgewater Associates, manages over $124 billion. Basically, he's so filthy rich that he can buy me at retail and sell me at a yard sale. One of his driving questions was, how can I create a portfolio that will do well in any economic season? After many years of work, he developed the perfect answer for this: the all-weather fund. To understand what the all-weather fund is, we must first understand what economic weathers or seasons exist. According to Dalio, there are 4 economic seasons. 1. Inflation, when prices of things rise. 2. Deflation, when prices of things drop. 3. Rising economic growth, growing economy. 4. Declining economic growth, shrinking economy. In short, every investment has a season they excel in, just like how in nature there's a season for surfing, a season for snowboarding, and so on. However, unlike in nature, we don't know what economic season will come next. So, what do? Dalio's solution was to evenly bet on each of the 4 seasons. When a season hurts a particular investment type, the others can pick up the slack. Unfortunately, the original version of the all-weather fund uses hard-to-access investments and leverage. However, there is a simpler version called the All Seasons portfolio that Tony Robbins uncovered during his interview with Ray Dalio. How did this All Seasons portfolio do compared to a famous stock index like the S&P 500? From 1939 to 2013, the S&P lost money 18 times, but the All Seasons portfolio only lost money 10 times. The S&P had a largest single loss of minus 43.3% compared to the All Seasons portfolio's minus 3.93%. From 2000 to 2015, which included all sorts of craziness like the tech crash, the credit crisis, and the European debt crisis, the all-season portfolio left the S&P in the dust, as you see here. After 2015, the S&P did manage to go on a bull run and surpass the all-seasons portfolio. Does that mean the all-seasons portfolio is useless? Yep, and I've just wasted the past 5 minutes of your life. Just kidding. The S&P is a pure bet on some economic seasons in which stocks do well, but the all-season portfolio is a bet on all economic seasons. Look at it this way. Let's say you had to bet your entire $100,000 life savings on who wins in a 4-player card game. You can put $25K on each player, or you can put the entire $100K on one player. What would you do? There is no right answer to this because everyone's going to have different needs and goals, but I do want to show you the main difference between the 2 portfolios. If you're enjoying this video so far and finding it helpful, make sure to hit that like and subscribe button down below. Without further ado, let's reveal the portfolio. It is made up of the following: 30% stock/equity, 15% intermediate treasury bonds, 40% long-term treasury bonds, 7.5% gold, 7.5% commodities. The goal of the All Seasons portfolio is to evenly spread out the risk/volatility, not the dollar amounts. Bonds take up the biggest chunk because they are the least risky. Stocks take up the second most, and commodities take up the smallest chunk as the most risky. The bonds counter the volatility of stocks, but what happens when both stocks and bonds fall? That's where gold and commodities come into play. The portfolio tries to get the best returns in the long term with the least risk. Additionally, it takes the guesswork out of investing, so you won't have to guess or predict what is coming next. Although this seems like the ultimate portfolio, it has weaknesses. To start, it is very US focused and lacks international diversification. Another main drawback is that it will do worse than the S&P 500 index during bull markets, as you've seen before after 2015. In fact, some people argue that if you take more risks, for example, investing more in stocks, you can make more. I mean, yeah, no shit, but you can also lose more. Countless studies have also shown that we are terrible at predicting how much risk we can actually take. We get emotional and sell things when they're cheap and buy things when they're expensive. This, by the way, is a fantastic way to lose your money. Lastly, since the portfolio is made up of mostly bonds, the pricing of bonds will affect how well the portfolio does. You probably don't want to start investing in bonds around 2020 when they paid less than 1%. If and when interest rates go up, bond prices and the portfolio will go down. Who will want your lower interest paying bond when the newer ones pay more? Stupid people. Critics claim that this portfolio only did well in the past few decades because interest rates kept dropping, so the older bonds which paid a higher interest were more valuable. Since 2020, interest rates have been going up, but there is no telling where they could go next. A point I want to make is the large bond allocation is not a gamble on bonds alone. It is to spread out your risk and prepare for any season. So now is the time for the $1,000,000 question. Should you invest in this? The portfolio is good for people who 1. Are scared about losing money and or 2. Want a simple way to grow their money steadily. Although this portfolio will lose money, it will minimize the crazy drops. On the other hand, it is not good for people who want high growth and are okay with taking bigger risk. For example, those who can take a 50% drop and not bat an eye. If you want to copy this portfolio, here's an example of the ETFs you could use. Lastly, Dalio says you need to rebalance this portfolio yearly. Rebalancing is a way to make more money and decrease your risk. What is rebalancing and how do you do it? This next video will answer those two questions.